The Smith Maneuver is a financial strategy centered around the idea of converting a non-tax deductible mortgage into a tax-deductible investment. As homeowners build equity within their home, they will then borrow against the equity through a readvanceable mortgage and then invest the borrowed funds into income-generating investments such as stocks, mutual funds, or other assets. On a surface level, the concept of this strategy can seem fantastic, but the reality is the strategy can create substantial risk. So in today's video, we're going to dive into the biggest risks that can occur when it comes to the Smith Maneuver and ways to potentially mitigate some of these risks. This video will be focused on the risk associated with the Smith Maneuver rather than providing an in-depth explanation on the strategy. If you don't already have a good understanding of how the Smith Maneuver works, I first recommend watching our explainer video on this topic, which we will link down below in the description. Starting out, probably the most obvious risk when it comes to the Smith Maneuver is the market risk. With the Smith Maneuver, we are taking out borrowed funds and investing in things such as stocks or index funds. But of course, when it comes to investments such as stocks or index funds, there is no guaranteed returns, meaning we could lose a substantial portion of our investments. For example, let's imagine that Susie decides to use the Smith Maneuver and borrows $10,000 against the equity in her home, which she will now use to invest in the stock market. This all seems great as Susie can now write off the interest on this $10,000 in borrowed funds. However, after investing in RBC stock, over the course of a year, the stock proceeds to drop 20%, meaning Susie's initial investment is down from $10,000 to $8,000. Now, the whole tax write-off doesn't seem so great as Susie has lost $2,000 from her initial investment and still has to pay back her $10,000 loan plus any interest. Even though Susie will still be able to write off the interest on this $10,000 loan, she'll still be in a much worse place than where she started, as the interest write-off will not come close to covering the $2,000 loss she has experienced from her investment. So in this scenario, the best way for Susie to mitigate her risk if she still chooses to use the Smith Maneuver is to look for safer investment options that have historically provided steady returns, while also diversifying her investments rather than investing in a single stock. Of course, this will lead to less upside potential on our investments, but when it comes to the Smith Maneuver, we need to remember that we are borrowing against the equity in our home. And this leads us into our second major risk with the strategy. When we borrow against the equity in our home, we are essentially using our home as collateral to secure that loan. And failure to repay the loan according to the terms agreed upon with the lender typically means that the lender has the legal right to take action to recover the debt, which may include foreclosing on your home. So of course, when it comes to the Smith Maneuver, we need to be extremely careful that we don't find ourselves in a place where we are over-leveraged and unable to pay back this loan. The last thing that anyone wants is to lose their home while trying to create a tax-deductible investment. While understanding this risk, if individuals still decide to use a strategy, mitigating this risk involves careful planning, financial discipline, and risk management strategies. Conducting a thorough financial assessment is a good way to evaluate your income, expenses, assets, liabilities, and overall financial stability to ensure that you can afford to take on additional debt and manage the associated risk. However, even with this assessment, it's important to recognize that things such as income and expenses can quickly change, meaning that also having an emergency fund set up is also going to be vitally important to mitigating the risk. Moving on, our third risk with the Smith Maneuver strategy revolves around interest rates. By borrowing against the equity in our home, we are typically leveraging something such as a home equity line of credit, also commonly known as a HELOC. And when it comes to these types of loans, they typically have a variable interest rate, meaning rates are subject to change, and not accounting for these changes can be extremely costly. For example, as we have seen all throughout the past 2 years, interest rates have gone up rapidly due to factors outside of our control. To look at an example, let's imagine that Nina started using the Smith Maneuver strategy back in 2020 and had an interest rate of 5% on her HELOC. But fast forward to 2024 and the same HELOC now carries an interest rate of 11%. This of course has led to a substantial increase in the cost of borrowing for Nina, and if this was unplanned for, it can quickly eat into all the benefits she expected to see from using the Smith Maneuver. To plan for and mitigate the risk of interest rate fluctuations, it's important to factor in these changes while looking at a benefit and risk analysis of the Smith Maneuver. Maybe the strategy seems beneficial at an interest rate of 7%, but if this rises to say 11%, how will that impact your strategy? Another way to potentially offset the risk is to invest in assets that also tend to rise when interest rates go up. such as GICs. Our final risk when it comes to Smith Manoeuvre is one that is very commonly overlooked, and that is behavioral and emotional risk. See, with the Smith Manoeuvre, individuals are gaining access to additional leverage through a readvanceable mortgage. However, once we actually have this capital, the biggest battle is deciding what to actually do with those funds, and this is where the behavioral and emotional risk is created. If you're someone who in the past has shown an inability to properly manage your finances in ways such as maybe overspending or over-allocating funds into very risky investments, then your financial risk is only going to be amplified with the Smith Manoeuvre. And that's because in this case, you're risking borrowed funds rather than your own money. So failure to properly manage this additional leverage can quickly leave you in a much worse place than where you started. To mitigate this risk, it's important to carefully evaluate your past behaviors relating to finances. This can include things such as understanding psychological biases, implementing strategies to manage emotions, and maintaining discipline in financial decision making. All in all, as outlined in this video, using the Smith Manoeuvre strategy does come with inherent risk. This isn't to say the strategy is not powerful, but rather that these risks should be carefully weighed against the benefits of the strategy. Before making any financial decision, it is always recommended to speak with the proper resources, such as licensed financial advisors, to ensure you are making the best decision for your own unique situation. That's all for today's video, but if there are any other financial topics that you would like to see covered on our channel, please let us know down below in the comments. And if you did get some value out of the video, be sure to leave a thumbs up on your way out and consider subscribing to the channel down below.